This might surprise you, but one of the most expensive things in your life may be something you cannot even see. It is what you do not know about money. Think about that for a second. A late fee here, a credit card balance there, a car loan with a bad rate, money sitting in the wrong account, a credit mistake that makes your mortgage more expensive. None of these things feels huge by itself, but over 10, 20, 30 years, they can cost you a serious amount of money. A 2025 survey from the National Financial Educators Council asked people how much they believed poor financial knowledge had cost them during the year. The average answer was $948. When that survey result was applied across the adult U.S. population, the estimate came out above $246 billion. Again, that is a survey estimate, not money somebody physically counted. But it shows how expensive small mistakes can become. And this is what I find crazy. Most of us were taught how to solve equations in school. We learned about cells, history, grammar. But then somebody gives you your first paycheck and basically says, good luck. Nobody really explains credit. Nobody explains debt. Nobody explains why a car payment can quietly destroy your ability to invest. Nobody explains what a 401k actually does. Nobody explains how one interest rate can change the price of the same house by tens of thousands of dollars. So today, I want to have the conversation I wish somebody had with me much earlier. No complicated finance language, no trying to make you feel stupid. Just money, explained like normal people actually talk about it. And the first place we need to start is very simple. Do you actually know where you stand? Because most people do not. They know their salary, maybe. They know what is in checking today. But if I asked, what did you actually spend last year? What is your net worth? What percentage of your income are you keeping? A lot of people would have no idea. So here is where I would start. Take your yearly take-home income, not your salary before taxes, the money that actually reaches you. Then calculate what you actually spend in a year. Housing, food, gas, insurance, car repairs, subscriptions, trips, shopping, debt payments, everything. And then subtract. If $60,000 comes in and $55,000 goes out, your surplus is $5,000. That $5,000 matters more than most people realize because income pays for your lifestyle. Your surplus builds your future. You can make $150,000 a year and still have no freedom if you spend $150,000. And somebody making $70,000 while living on $50,000 may actually be building more control over their life. That is the first shift. Stop being impressed only by income. Ask what somebody keeps. Now take that one step further. Net worth. Add what you own. Cash, investments, retirement accounts, home equity. Then subtract what you owe. Credit cards, car loans, student loans, mortgage, personal loans. What is left is your net worth. And if it is negative right now, that is not some final judgment about your life. It is just the starting number. What matters is whether that number is moving up or moving down. Now let's talk about one of the biggest reasons it moves down, debt. This is where money becomes dangerous because interest can work both ways. It can work for you when you invest, and it can work against you when you borrow. The Federal Reserve's current data show commercial bank credit card accounts being charged interest averaged about 22.15%. 22%. Just think about that. You are trying to invest and maybe earn a decent long-term return. Meanwhile, a credit card is charging you more than 20%. It is like trying to fill a bucket while somebody drilled a hole in the bottom. And this is why I always say, before you get obsessed with investing, make sure interest is not compounding against you. Now, if you have debt, you have two simple ways to attack it. One is called the avalanche, highest interest rate first. You pay the minimum on everything else and attack the most expensive debt. Mathematically, that normally saves the most money. Then there is the snowball, smallest balance first. You clear one account quickly, then move that payment to the next one. The snowball may not always save the absolute maximum amount of interest, but psychologically, some people love seeing accounts disappear. Which one should you use? the one you will actually finish. Because the best financial plan is not the one that looks perfect in Excel. It is the one you can still follow 6 months later. And while we are talking about debt, we need to talk about credit. Because a lot of people think credit score means how good are you with money? Not exactly. A credit score is mainly helping a lender estimate risk. In the general FICO framework, payment history makes up about 35% of the score. Amounts owed about 30%.